So my name is Hillery, and I have the privilege of moderating this panel of really top-notch VCs. And the way this is going to work is we're going to quickly introduce them, and then we're going to try to save some time at the end for some questions. And just right now, the rules of engagement for the questions, this is not the time for an elevator pitch, period. So even if you think it's compelling, you can get to them later if they don't successfully exit through the back door. So I'm very pleased to introduce to you our distinguished panel, starting with Marlon Nichols, and he has a fund called the Mac Fund. We have Bill McAleer, William McAleer, who's the founder of Voyager up in the Northwest. And then we have, as our incredible pinch hitter here, Mark Linao from Progression. And I would appreciate it if each of you would just say a few words about, really your place in this ecosystem, what your fund is all about, and why you decided to leave rocket science to become a VC. We'll start with you, Mark.
Oh, thanks. Hi, everyone. Thanks for being here. I'm a general partner at the Progression Fund. The Progression Fund is an early-stage consumer fund. We invest in only consumer-focused companies, which means B2C. We focus on pre-seed and seed stage, and that means first institutional round of financing, or second. And what we invest in is the future of how consumers play, shop, and live. And we tend to focus on services and companies that are creating for the Gen Z and millennial audience. So thanks for having me.
Bill?
Great. If we have any tough consumer questions, he's the guy to ask. So we invest in B2B companies. We focus on the Pacific Northwest. We call it Cascadia, which includes Western Canada, Washington, and Oregon. And we're focusing on three sectors. So we do a lot in AI analytics / machine learning. We've done that over the years. AI has been around for a lot longer than anybody realizes. Second area we look at is what we call enterprise transformation, which are largely vertical SaaS software solutions. And then the third area, what we call disruptive technologies, technologies that are disrupting industries. And we're looking at ag tech quite a bit right now as one of those.
All right, Marlon.
Awesome. Yes, at MAC, we're a seed stage fund. We manage roughly $500 million across two funds. We are primarily North American investors, but 10% of what we do is in Africa, specifically Kenya and Nigeria. And we are agnostic in terms of sectors. So we've invested in baby food to re-engineering the tampon to reusable rockets. So wide range there.
Fantastic. Well, and this is such a great panel in the sense that each of you come from very different backgrounds, have very different perspectives, especially what's happening these days in the VC community. And this has been kind of an interesting time for all of you. And just for those of you who are curious, I'm an attorney. I work with the VC community often, both as corporate counsel and in-house counsel for some of the larger institutional clients. And I'm VC adjacent, and I have heard that there has been quite the shift in the VC funding, let's just call it return on investment, and some would go so far as to say degrowth, and you know who you are, Evan. So I'm curious to know whether or not you see this as a particularly challenging time for VCs, and or is this a moment of opportunity? Is this a moment of course correction? Because quite frankly, a lot of the funds haven't done as well as they have historically.
Who wants to tackle it first?
I feel like we're being put on the spot. But yeah, I mean, I think it's all of the above. I think broadly, it's the last 10 years have been where there's a lot of money. It's been a lot easier to raise financing from everything in venture. And it's not that dissimilar to what happened to people's portfolios in the last, I guess, like year or so. With I guess the macro environment picture is it's harder to raise capital. It's been harder to return money to LPs, who are our investors, and normally there's been liquidity there, and the value of companies have come down from where they were marked at previously, and people are buying, trying to get things at discounts, which is an opportunity. So yeah, it's been absolutely harder in our industry. It's been harder to raise money as a venture capitalist investor and as a founder who's raising money from VCs, because things have kind of stopped. I can kind of go on, but I guess anyone else's. I think there's some shining bright stars. Like this conference seems to be talking a lot about AI, a lot of opportunity, and there's discounts to be bought, but absolutely challenging.
Yeah, I think we had a 2-year long party and drank a lot, and now we're having a hangover essentially, right? So if you look at the numbers in venture in terms of like the dollar amount that was invested, the number of companies that were invested in, the number of venture firms that got invested in from their limited partners in 2019, and you look at the numbers today, the numbers today through Q3 are actually higher. But the last 2 years, they went like that, right? So we're kind of coming back down to normal, and it never feels good. But that's just where we are. And I think the primary reason for it is the cost of capital, right? So we're near zero level interest rates, so cash was free. So it was very easy for our investors, the folks that invest in venture firms, to keep putting money our way. Well, now that costs a bit, right? And so they're rethinking that. So over the last 2 years, I might have been able to go out and just invest my entire wallet in a year, come back to my investors and say, hey, give me some more money. And they're like, sure, it doesn't cost us anything. Here you go. Today, it's a conversation, right? And when you think about the chain of things and how they work, if I don't have capital to invest, then I can't invest it into startups. And most investors in our space weren't, I guess, responsible in terms of how their deployment pace. So a lot of these firms are actually out of capital. They're now back in market trying to raise capital so that they can invest, but they can't tell you guys that, right? Because they don't want you to ever think that they're out of cash, because that's not a good thing.
Yeah, that's not a good thing.
Yeah.
Yeah, I would agree with Marlon. We've had this bubble, and basically the mountain's gotten shaved back to where it was. And I actually think that creates a great opportunity. Marlon's point, though, is we had funds in 2021, 22, into the first part of 22, that were investing at very high valuations, at ridiculous prices, and putting out money like crazy. Those funds are going to get really hurt, because the challenge is when those companies that they invested in go back to then raise capital again, they're going to have a really tough time unless they want to take a down round. So what we've actually seen, as Marlon pointed out, the level of VC funding is almost the same, almost identical this last quarter to where it was in 19. So this whole thing's been shaved off. We actually think it's a great time to invest. It is hard to raise capital as a VC because the choices that the LP has are to put it into safe investments at 5%. We're yielding 18 to 20 is our target, right? And so we have to be able to articulate that we're going to have a better return to this LP. And then the other issue that's happened is the LPs have had public market holdings, which then creates what's called a denominator effect, meaning that usually most LPs are allocating 15, 20% of a portfolio to private equity. When the value of the other market holdings goes down, your private equity number goes up. And so you do see some LPs now that are constrained in terms of what they can put out. On the other hand, as far as investing is concerned, I think it's a great time. Prices are come down, and it took about 6 to 9 months from the crash, which was in basically February 22, for these early stage valuations to come down. Second is we've got a huge wave of computing coming with AI. You heard a lot about it today. There's a lot of PR, probably overhype to it, but there's also a lot of substance to it. And then the third is companies are going to come back asking for capital again, and we may find some bargains.
Yeah, I just want to double click on one thing Bill said, which is like now is a great time to invest. So, I mean, just raise your hands. Is Uber and Airbnb, are those successful companies? No, no one thinks those are successful companies, or are you all just sleeping from lunch? Like those are definitely successful companies, and those were both founded during economic downturns, right? And the thing that happens during economic downturns, you get the best founders, right? The ones that truly have conviction about building something that's worthwhile building. And so we're back there. So I absolutely agree that this is, if you can find them, this is the best time to invest.
Well, I think you raise a really good point around finding those target investments, finding that, not even a unicorn, I guess just a pony that's going to have a good return on investment over time. So how are you evaluating those types of investments these days? I mean, so I get the sense that when capital is easy to collect and it's easy to make more risky choices in investing in various industries or target companies, you may not be as careful, and you may take bigger risks. But now it seems, at least to me, that might not be the case. Is that your experience? How are you looking at new potential investment opportunities? And has that changed at all for you?
So extreme competition can cause bad habits, which is a part of what we saw in the last couple of years. Like due diligence is something that, as a venture professional, you should absolutely do. But FOMO played a big factor in a lot of firms not doing any due diligence. And so that sped up the time that a deal was getting done. And so you had a lot of firms just pouring money into companies that they didn't properly vet. That's not something that I think is happening now, because folks are taking longer. They have more time to put in the work to figure out, is this company viable, right? And there's more focus. The other thing that we saw in the last couple years was just like growth for growth's sake, right? Because capital was so cheap, just grow. We'll find the money and we'll give it to you. Just keep growing, even though that growth is in no way profitable. Well, that's not going to fly today, right? Today, unit economics matter, and you have to be growing responsibly, still rapidly, but responsibly. And so those are some of the things that we're looking at. The other thing that's important is how much capital are you raising? What are the milestones you're going to achieve with that capital? And do you have at least 24 months worth of runway? Because we're in a terrible market right now for fundraising. It's just going to take longer. And if you think something's going to happen in 12 months, it's probably going to happen in 24.
Yep. Yeah, I think what we look for, especially we are like, can you do more with less? And we ask that of our portfolio companies, and that's kind of the new lens that we look for companies as well, like Marlon pointed out. And a lot of this has to do, again, with money was cheap, and I think even Warren Buffett said this. You see really irrational behavior when as interest rates get lower and lower, and we saw the best of the best make the worst mistakes, and one company turned out to be a fraud. Talking about what happened.
Just one?
Or a few.
A few, actually, a few. But
FTO.
a few came out to be a fraud. But it's interesting. The best of the best did not do their diligence, which is kind of crazy. How humans reacted in that environment.
Well, the other thing I think has happened too is you had a lot of entrepreneurs that had not really been through any kind of downturn. And so their real life expectation was what was happening in 20 to 22. And so they thought valuations were great. I could get capital easily. People were hunting down my companies, and that was really kind of what was going on. But that's changed now, and I think we're back to we've reverted back to the mean, which is that we're looking for companies that not only have a great technology, but can actually speak to what they're going to do with a customer. And how are they going to create value, or how are they going to impact or disrupt an industry? That's kind of what we need to find. And I think it's a little bit more back to the basics.
So I loved it when you referred to this, Marlon, as the hangover time. And we're course correcting in some ways. So, you know, as with some hangovers, you've got some regrets the next day. What would you consider to be a regret from your last fund cycle or the last investment that you made? If you knew now, for example, back then, what you know now, what would you do differently, if anything?
I mean, I love all my babies.
Equally, yes.
Yeah.
So we're not going to do that one. I'll say this. You know, every good VC has of scale has a reserve strategy, meaning that you're holding back a portion of your fund to continue to invest in the companies that you've already invested in. So you might have participated in the seed round. Now you want to be able to participate in the Series A. This market was one where we weren't expecting to have to do the tweener rounds. So between the seed and the Series A, the seed extension, the seed extension, the seed extension.
The bridges, the mini bridges,
the bridges.
and then the ropes to the bridge,
Right.
and the duct tape that goes
You just don't
to
want
the
a
rope.
pier, that's the thing.
Right.
You want a bridge, not a pier.
Right.
There you go.
Right. So I wish we had I wish I had a crystal ball to see that, you know, the markets were going to turn in the way that they turned, so that we could have reserved a bit more capital. Because unfortunately, I mean, we have a really strong loss ratio, but we did lose a few companies that were, you know, moderate performers that if given some more time, maybe they would have turned it around. And if we had, you know, if we knew that this was going to happen in the way that it did, we would have held back a bit more to be able to support those companies as well as our really high-performing companies.
You know, I think the biggest challenge that and entrepreneurs faces too, sometimes you have is you'll have an interesting company and it's time maybe to sell it and maybe time to exit it. And you have to get alignment with your investor group that it is a time to do that. And I think if we had any regrets, we have one or two companies that could have easily exited during a period where there were really good opportunities to sell the company. But we couldn't get total alignment with the investors. A later stage investor wanted to have a bigger return. And we've got a couple of them now that fortunately they're funded, but we're going to have to wait a little while to get the exit. We had another one called ZipWhip that did business text messaging where we got that alignment and we got the company sold within a month of the February crash at $1 billion, which was great, to Twilio of all companies, which I know nobody follows Twilio, but when we sold the company, it was $350 a share. Now it's trading at 60. That's a public company. So that would have had a huge impact on, you know, our returns. Fortunately, we got alignment and got that done. But I think that's another challenge as an entrepreneur. If you are raising capital, it's really important to think about who your investors are and what their expectations are going to be for ultimately getting an exit, and make sure it not only aligns with you as the entrepreneur, but also your board gets in alignment with it.
Yeah, secondaries are trading at like 60% discounts right now.
Yeah, and the other thing is there are secondary interests floating around in a lot of these late stage companies that are private, and the discounts are huge on them, you know, to get liquidity.
Yeah. It's been, you know, I think that's a really good point. I think there's a lesson here. Always, like, take some chips off the table.
Yeah.
I think the best fund managers I know had sold at like the peak, and you know, so in hindsight, it's 2020, but absolutely wish I sold some stock even, like you know, like public stock at that time. So I think it's a really important lesson just in investing that you should be taking some chips off the table. But as pertains to VC, for me, we've definitely made some mistakes as a firm, but I think we've definitely overpaid. And one thing I wanted to bring to light is like, I guess, hype cycles. We had looked at some of the Web3 stuff and the whole, is everyone familiar with, I don't know, like NFTs, blockchain, we're still looking at that space, but some of those companies were so overvalued and you had to make a decision within 2 days, or you're out of this round, and blah, blah, blah.
VR, AR.
And you were seeing behavior like, oh, I'm going to fly this founder out in a private jet just so that they can take my money. Like, we had to convince people to take money. Like, not that we did that as a fund, but we saw that behavior. And this person's doing it who's really smart. Again, to the diligence question, so maybe we don't need to do as much diligence because this other smart person's doing it, and that was a huge mistake. Those are so definitely never again. Yeah, that's one thing I would say. I would not like chase the hype, and right now we're kind of in a hype cycle of AI.
Yeah, we are.
Not to burst anyone's bubble here, but it is to like, you should look at these things practically and rationally, and is there a path to profitability eventually with these companies? I actually don't know. Like, how much money are some of these companies losing? And is there a unit economics argument to be made for some of these companies? You know, we have to do your diligence if you don't know.
Well, I think that's a really good point around certainly the hype cycles. You know, so is AI another hype cycle, or is it a hope cycle? How is the transforming world of technology impacting your investment decisions? Well, and maybe more bluntly, do we even need VCs anymore? I mean, we've got generative AIs.
To do the diligence, right? Yeah.
Well, yeah, maybe
To
more.
pick the companies. Well, you know, I think we're in, if you look at I don't know how many of you follow the Gartner hype curve or not, but you know, if you look at where ChatGPT is, as an example, which is the consumerization of AI. I mean, it's equivalent to what the internet browser was, you know, for the internet. Suddenly, consumers can access AI and, you know, generate the questions for this panel if you wanted to.
Exactly.
Or the answers to this panel. Some of you could just put it in there and get the answers. You know, that is peaking, you know, and it was the fastest adoption of any technology, probably consumer technology ever. But it's also starting to deteriorate in terms of the usage patterns. If you look at the overall AI curve, there's all kinds of, you know, categories of AI that fit on that curve, some of which are rising and some of which are not rising, and some of which are in what's called the trough of disillusionment, meaning they're coming out the other side. And so you have to actually look really carefully at what the opportunity is and really understand that fundamentally that opportunity has to create some value for someone, and it's got to get monetized, to your point.
How are you looking at AI these
I
days?
am AI. Yeah, I think there are two primary categories. Well, first of all, I don't think we're anywhere close to AI truly disrupting venture capital, because the way that AI works now is it's backwards looking, right? So it's taking a bunch of data and it's making recommendations, right, based on that data. A big part of successful venture capital is to be able to see something in the future that does not resemble anything that happened in the past. So I think we're still a ways away from that. As we're looking at, we've been investing in, like Bill said, we've been investing in AI for years without the hype cycle or the big AI brand as attached to it. Because of the size of our fund, we're not investing in kind of the foundational AI type things, right? Yeah. I think those things are going to be built by the Microsofts and Googles of the world, right? Yeah. They're just super capital intensive. Where we're investing is like the application layer.
Right.
And the way that we do this is we look at the underlying business, and what we're trying to assess is whether or not that underlying business has real legs. Can this be a successful and profitable company, right?
And leverage
now
the existing infrastructure to get that done from an AI perspective.
Before even considering AI.
Okay.
Right? Mm-hmm. Now, if that is true of this company without having this AI element onto it, if I add AI to it, does it accelerate the growth? Does it do so in a cost-effective way? And are they leveraging something within this AI that's truly differentiated from competitor XYZ?
How about you?
We're definitely looking at the space and have made some investments. We look at it from a consumer lens. Absolutely think that AI is going to be an integral part, or already is, in people's workflow and how they learn, how they play, and how they shop. I guess on the companies, I think we're being pretty sensitive right now in terms of valuation to the previous thread. But I think we are moving a bit towards this AI world. It does seem like, but previously a lot of decision making was very deterministic, and take us self-driving cars, for example. You go to a stoplight, to make a right or a left, or you can go forward. Now the AI is like, the way the chips are made is like, the way the decisions are made is like, oh, the probability of this passenger wanting to go right is more often than not, so they're going to go right here. That's very helpful, but that can also be a problem when you can't override that,
That's
right?
true, yeah.
But everyone, if you follow NVIDIA stock, that type of decisioning and I guess probabilistic decisioning requires a lot of compute. So, and you saw there's be a lot of demand for those for what they're building for their chips. So we're definitely investing in that space because we think that's going to be disruptive. It's just right now a question of what we're seeing in a question of like, do consumers really play with this or will use it consistently, and are they coming back to the services that are built in AI on a more regular basis? Because there is Bill and I were talking about this earlier, there is a churn issue in AI, in consumer AI right now, which means people are going there and using it, but 30% on average of a user will not come back and use that service, which means it's not that sticky yet. So those are the type of things that we're thinking about.
Well, we've got exactly 30 seconds left. So I'm hoping if anybody has any quick questions, we could take them now. But if not, I really want to thank all of you.
We got Will Poole over there.
Oh, Will.
My name is John Patoti. I've been doing angel investing for the last 25 years. And I'm always trying to figure out a way to build a friendly bridge over to the VC world so we work together. But what do you guys think of the rising popularity of the secondary markets, such as like EquityZen and Forge, and where that's heading?
You want to take it?
I was looking at you. Yeah. Wow. So secondaries have had a really nice run. And they were actually, we consider them to be a pretty lucrative outcome for some of our positions. In today's market, wearing my VC hat, it sucks, all right? Because they're literally asking us to take upwards of 60% discount on positions that we hold. So unless there's a true need to find some form of liquidity, non-profitable liquidity, then we're not going to do it, all right? Now there are some firms that are struggling to raise capital and have to show what we call DPI or some form of exit, and so they'll bite at some of those things only because they have to. I think it will come back. We are resetting the market. The late stage valuations are coming down to where they should be, and after a while, I think secondaries. They are already mirroring that, but once we get our heads around that, I think it'll feel like business as usual.
Will, do you have a quick question for us? And then I think we're going to have to wrap it up.
Yeah.
Just guidance to founders back in the before times when you raised a seed whatever round, you felt pretty confident you could raise the next round. You didn't have to have a conversation about path to cash flow break even. I actually told a founder to get that tattooed into their forehead, CFBE, recently, because they weren't internalizing it. And my question is, when is it expected that you'll be able to raise another equity round without having that path clear? And when do you absolutely have to have that path, or don't even bother seeing one of you?
Yeah, I don't think any reasonable venture professional is expecting a seed stage or a pre-seed or even a Series A startup to come to the table saying, yes, we're going to be profitable in a year or two, right? But what you do expect is that you have good margins, right? So that your sales process, your marketing process, that's profitable, right? Because if that's not profitable, there's no way that you're going to get to bottom line profitability. So it's more, the conversation is more about that.
Well, the other thing we're guiding all of our entrepreneurs to right now in this market is 24 months. So minimum, get funded, be able to go 24 months, and do a good job to extend that runway. And to Marlon's point, we don't expect profitability immediately, but if you're at a Series B, C round, you better show a good way to get there. So that's kind of the reality.
All right. Well, thank all of you.
There's one more.
That's
We're going to get the yank here? Or?
No. What do you guys think of incubators? And if you've got a positive or a negative thing to say, what is the one thing they can do to help you?
I think it's a fad, once again, but I do think there are some that have substance. We saw a huge number of incubators back in 2000. It was like the thing to do, and half of them failed, 3/4.
Bye-bye rework.
Well, there are some. I think Techstars is one that has got a very good discipline around it. Another one that we actually helped start in Seattle is called CDL, Creative Destruction Labs. It's across 12 different nodes. Deep science, mentor-oriented. I think if it's got strong mentorship, strong investor participation, good network, makes sense. Also, some of these entrepreneurs, because they are engineers, they're very technical people, they need the help to kind of help think about how to build that business. So I think that's where they are helpful.
All right, I think we're out of time.
We're out of time.
Okay, thanks.
Thank you so much. Thank you, Mark, Bill, Marlon, and thanks all for having us.